My name is Carl White. I'm your host here for the next bit, and you are listening to the Author Showcase. And this is the Scotsman Guide podcast, where we showcase the authors of the magazine. And if you haven't subscribed to the magazine, boy, go to scotsmanguide.com and subscribe to the magazine. And you'll also see the rest of the episodes of the podcast, along with the articles in past that we've done episodes on. So today I'm joined with a good friend of mine, and actually was the president of the California Association of Mortgage Professionals, which, brother, standing ovation for what you guys do for our associations. We really appreciate it. So Mr. Houtan Hormozian himself, coming out of Los Angeles. How you doing, my man?
I'm good. Thank you, Carl, and thank you that warm welcome. It was my honor to be the association's president. I truly enjoyed it. So thank you for that.
Well, I feel like I'm talking to somebody of the Marine Corps, man. Thanks for your service. And probably sometimes it probably felt like you're in the Marine Corps at some level. So so thanks for being here. Anyway, dude, you wrote a great article. It was in the residential edition in the July issue of the Scotsman Guide. And it was the title of it is A Good Loan Option with an Asterisk. So the little subtitle was clients must fully grasp the benefits and the drawbacks of adjustable rate mortgages. So the article was about adjustable rate mortgages. So let's kind of dive into that. I think the last couple of years, going back into, say, I don't know, 2020, 2021, the idea of an ARM might not be so attractive with rates in the low single digits. I think there were some 2% mortgages going around. Today, it's a little bit different, a little bit more attractive, isn't it, Houtan?
Absolutely. I mean, in today's climate, lower interest rates makes the affordability just that much more appealing and possible. So ARM loans are definitely needed in today's market compared to 30-year fixed loans.
Yeah, I agree with that. Hey, before we dive into it, give us a brief introduction about your background and your experience in the mortgage industry. Who is Houtan?
Sure. So I've been in the mortgage industry for nearly 20 years. I started as a wholesale account executive, 20 years ago, right? And I guess I can say I found my career and passion within this industry. Great group of people, great industry. It's definitely challenging, so it keeps me on my toes, and I truly enjoy every minute of it. I mean, I wake up early in the morning when the market opens up. So I'm in Los Angeles, and market likes to open on East Coast time, so it makes me wake up early. Trust me, not my favorite thing, but I do. And I usually get home around 7:30, 8 o'clock. So the industry is my passion. I had a pleasure of being a loan officer, being a manager, being a business owner, and most recently being the president of the California Association of Mortgage Professionals, helping and serving the mortgage industry and the community in California.
Yeah, and I think we just saw each other just a couple of days ago at the California Association Mortgage Professionals gala there. So we all inducted the new president. So it was good to see you there. Hey,
great having you.
Yeah. So could you describe what's some scenarios in which an ARM might be beneficial choice for a borrower? Because my guess is a lot of people that might read the Scotsman's Guide or listening to this podcast might be newer in the business. And the idea of doing an adjustable rate mortgage is something, frankly, kind of new to them. As seasons, you and I have been in this for decades, right? And we've seen it come and go. But give us some scenarios for somebody that not be quite as familiar with them, in which an ARM might be most a beneficial choice for the borrower.
Sure. Like you were saying, Carl, I mean, taking the last 2-3 years out of the picture where, fixed mortgages were in the low twos or mid twos, taking that out of the equation, typically speaking, adjustable rate mortgages offer lower interest rate to the consumers. And where it's mainly beneficial is for mortgage planning. When you have clients that they're going to keep the property for 3, 5, 7 years, and you have the opportunity to look at it as saying, look, even if I add additional insurance and go with a 10-year fixed adjustable rate mortgage, I'm still getting a lower interest rate for the consumer, which saves them money both on an interest and on the monthly payment, right? So it has a lot of benefits when you look at it from a mortgage planning standpoint and what the consumer is trying to get accomplished. Then there's different factors. A lot of clients look at these. A lot of investors look at the adjustable rate mortgages because they do want to refinance every 3 to 5 years for recast purposes. So there's just not the factor of, hey, I'm going to get a lower interest rate because my monthly lower, I will have a lower monthly payment. But there's also investors that are looking for certain benefits as a result of the adjustable rate mortgage. There are certain people that are basically looking at adjustable rate mortgages just because they know they're going to keep the loan for 6 to 12 months, right?
Yeah.
And they don't want to pay the interest. So you got to go through the interview with the client to understand what their needs are before you say 30-year fixed mortgage is the only mortgage out there.
Yeah. Brother, I can tell you from personal experience, of the last 10 houses I personally bought for my own self, I bet half of them, maybe more than that, probably half or a little better than that, I did on adjustable rate mortgages. I thought it's worked out well for me. So the obvious pro of this thing is typically they're going to come at a better interest rate than the 30-year fixed. Let's talk about I don't know, I don't want to sound over dramatic, but the negative side of an ARM, or the danger. Danger sounds like an awful strong word, but what's the cons of doing an adjustable rate mortgage?
What could go wrong, right?
What could go wrong?
Well, I mean, hey, if we had a crystal ball, we probably would be playing the lottery, not play the mortgage. But I mean, the reality is there are always circumstances where things could go wrong. I mean, there's unforeseen circumstances that could happen. But one of the most typical downfalls with adjustable rate mortgage is when people don't really do the mortgage planning the right way, and they take on a 5-year or 7-year ARM when they don't know if they're going to be getting out of that mortgage, right? Whether they're going to sell the property or refinance, and what their ability will look like. I mean, I always tell people it's not always about how long you're going to keep the property, but it's really about how long you're keeping that mortgage. You could keep the property forever, but if you're saying, I'm going to take out an ARM today because it has a lower rate, but the market trend shows that interest rates are hiking, as we've seen over the past couple of years. And if you have a short-term ARM and it's due to recast, if it's about to balloon, then you're going to be subject to a much higher monthly payment just simply because the interest rates have risen, right? So that's one of the most common issues that I see for people that take ARM loans out. And rightfully so, they should be scared, because if they are taking a 3-year loan and they don't know if they're going to be able to refinance, that's where it gets scary. Outside of that, if people just do the right planning, and again, I keep going back to the word planning, because I always tell people we're not mortgage salespeople. We should be truly mortgage professionals. We should truly be a mortgage planner. You got to educate your customer that, hey, what will happen 3, 5, 7, 10, 15 years down the road? If you want that consumer to come back to you and say, now I want to take a second mortgage and a third mortgage and a fourth mortgage. If you set them up for success, you're basically setting yourself up for success.
So when we're having the conversation, like we have a prospect, a borrower reach out to us and say, hey, I was referred to you and I'm calling you up now. At what point do we introduce the idea of an ARM? Or do we only bring it up if in our talking with them, in our own mind, we think, hey, this might be a good option? So do we offer it? Do we give the option to all of our clients, or do we select which ones, and how do we do that?
So I'll say you give it to all the clients. It's an option that exists out there. And if you don't present it, someone else might. And the worst thing that could happen is they might present it in a harmful way. Now you lost an opportunity to educate that client. I always present an adjustable rate mortgage to the consumer as one of the loan program options that basically has advantages by a lower interest rate, but also based on my discovery call with them, I'll find out what is their plan. Are they looking to stay in a property in 3 to 5 years? Are they looking to downgrade or upgrade? What will their future needs be, right? And that's a lot of questions that you have to know what to ask. A right question needs to be asked in order to get the right answer. And
Mm.
what I find out is when you go through that discovery call, you can present them and let them know if the arm is a good solution that you would like for them to consider, or if an arm loan is a risky option for them, right? It's never to discourage a consumer from taking on an adjustable rate mortgage, but it's more of giving them the education for them to realize what will be the advantages for them if they do, and what are the risk factors that they have to take into consideration if they go for an arm loan.
Mm. I like that. What are there any common misconceptions of arms that you encounter, or do pretty much people understand what they are?
One of the most common misperception is that they don't know the difference between a balloon loan versus a typical 30 years amortization loan.
Mhm.
Uh, One of the myths I realized, found out, and I go through it with the client is when you tell them about an arm loan, they're like, well, what if I can't pay it off in 5 years or 7 years or 10 years, right? Their assumption is that it's only good for the duration of the time that the adjustable part is fixed. Not realizing that, okay, once it adjusts, and that's what it really is, it adjusts, and year over year, the interest rate can change. You still
Mhm.
have the same 30-year loan, but now at a higher interest rate or lower interest rate, depending on where the market is headed, right? I mean, you and I both seen that people that had adjustable rate mortgages before the crash, they took advantage of those loans because once the Fed rates went down, so did their interest rate and their monthly payment. So it's not,
Mm.
and that's why I would say it's not always a bad thing. You just have to make sure you're planning for it the right way.
Are there still are explain what a negative amortization is, and then part two, are those options still available today?
Ooh, negams. So I've heard there are a couple of investors out there that are actually offering negam loans, and they have gone to the core of what a negam loan was designed for. Basically, your high net worth, extreme savvy investor that can understand the advantage and disadvantages of that mortgage program. Um, so from what I understand is one or two investors out there offering it. It's not open. They're giving it to their own exclusive private banking clients only based on selection. And what are the advantages and disadvantages of NEGAM? So,
Explain before you, just in case somebody's newer. Explain what a negam is,
okay,
and then the pros and cons.
sure. So basically, when you're taking out a mortgage that allows you to make a payment based off of just a 1% interest rate, regardless of what your fully amortized or your fully indexed interest rate is, or your even low teaser rate would be, what you're essentially doing is running a negative monthly payment. Um, Kind of similar to a reverse mortgage, not to get
Mm.
into a different mortgage product, but every month the payment that you're making is not even enough if you were about to stick with the minimum monthly payment that is due to even cover your standard mortgage monthly payment. So the difference between a payment that you're making versus what your payment should have been is getting added on to your principal balance.
Okay.
Sounds like a credit card minimum payment, right?
Yeah. So now, if my loan started at 300,000, and let's say my payment, and I'm using air quotes here, should have been 2,000, but I'm only making 1,000. They just tack at the end of the month. I owe 300 and 1,000. Next month, 300 and 2,000, so forth. So pros and cons of that. So what's the good and the bad?
So the good, if you're an extremely financially savvy consumer that utilizes its cash flow to make money somewhere else, which is very common for self-employed borrowers that are, in my experience, that are basically an import-export business. They're always buying inventory, they're holding on to it and until it gets offloaded. So it helps them. It's a tremendous help for their business cash flow because now they have the ability to buy a larger bulk purchases, which helps them to make more money, right? So on a extremely financially savvy consumer, they utilize these program on the months that they have cash flow issues. And it's not the cash flow issue because they're short on funds, it's because they haven't received what they have sold from their client, right? And that's why I was saying a lot of the couple of investors that I know, they offer this exclusively to their own clients that do business with, because
Yeah.
they have control over the client's cash flow. The disadvantage or the cons of the program, well, if you get stuck in the rut and continuously make that minimum payment, you're increasing your principal balance, and it's a compound interest. So 3 years or 5 years of making that minimum payment, your principal balance could easily be doubled up depending on where the index is.
Got it. So so let's go back to talking about ARMs in general. Are ARMs something that's primarily done just with purchase mortgages, or are you offering that for your clients on the refinance market also?
No, we offer that on refinance market as well. I mean, at the end of the day, it's a great mortgage program that exists out there to help consumers achieve their mortgage goals, right? A lot of consumers get, just like you were saying, they just do purchases on our ARM, or they come back and they want to refinance. And in today's climate, well, we know the rates are pretty as high as they could get. So if they take on an ARM if they take a 5-year fixed ARM or a 7-year fixed ARM, it's almost guaranteed that when the time, and please note I said almost guaranteed, it's not guaranteed, it's almost guaranteed that as the Fed starts decreasing the rate, when time comes for them to get into the adjustable portion of their mortgage payments, they could have a lower monthly payment because the Federal Reserve rate has gone down, and now their fully indexed will be lower than what it is currently today.
Yeah. Yeah. So yeah, that makes perfect sense. So we know that ARMs are based on different indexes. In other words, when they adjust, they can't just hypothetically pick a number and go, and it's going to 15%, right? It's tied to an index. Are there any specific type of ARM that you're recommending or you're offering to your clients more than the others, like a 1-year ARM or a 3-year or a 7-year, or maybe based on the LIBOR, or based on like, what is there one particular one that you're kind of grabs your attention more than the others right now?
Well, the index itself, I mean, I've noticed most of our wholesale lenders are going off of the SOFR concept. But as far as the term goes, I typically stick with a minimum of 5 years and try to cap it at 10. But to me, what I've noticed is, as far as the interest rate goes, the sweet spot is really 5-year or 7-year ARM. When you go to a 10-year ARM, there's not much of a difference between a 10-year ARM and a 30-year fixed mortgage. So when you look at the pros and cons, or you want to do the risk analysis, in my opinion, it just kind of makes sense to go with a 30-year fixed as opposed to a 10-year ARM, because you're not really saving that much on the interest rate itself.
Yeah.
Yeah. But 5-year, 7-year, depending on their mortgage needs, I think it's a sweet spot for a lot of customers.
What percent of your, and it doesn't have to be a large percentage to make sure, offering, dude, I love what you said a few minutes ago, where I asked you, how often do you bring up this conversation in your recommendation? And I couldn't agree more with every single client, because if they don't hear it from you, maybe somebody's buying a trigger lead and then calling your client, and they offer, oh, did your loan officer mention that you can get a rate as low as this on an adjustable mortgage? And now you got egg on your face because you didn't bring it up. So I love the idea that you at least bring it up on every client. Do very many percentage wise take it up on it at this point, or it's a good thing to bring it up, but not many's actually using it? Where do we fall on that with your own personal book of business?
So I've noticed office wise, we're pretty 50-50
Interesting.
in today's climate. Our first time home buyers or the transitional buyers, we're more still comfortable giving them a 30-year fix if they can afford it, unless we feel comfortable enough that they have a pretty good grasp on their finances and their employment. But almost every investor that is coming through the door and trying to purchase an investment property, or if they're doing any kind of creative financing, they're taking on an ARM just because they know they're not going to keep that mortgage for anything more than 5 to 7 years.
Yeah.
So surprisingly, I was looking at our pipeline that closed last month. We did a handful of 3-year arms, which was surprising to me. But I would say about 90% of them are a 7-year arm at this market.
Yeah. Brother, I've owned well over, I don't know, a couple dozen houses, and I've never held a mortgage more than 7 years. I was just sitting as you're talking, I was just going through my head. Heck, there's been a very small handful that have had 5. And so I think it's just a great option. I think having this as one of the arrows in your quiver is a great thing to do. Hey, I see we're here coming up on the top of the hour. Are there any particular resources or tools that you use for explaining the arms to your clients, or is it you just have a quick conversation? Is that how it usually works, or is there any tool that you're using?
Yeah, so no, I don't really use a specific tool nowadays. It's more of just having a very common conversation, because you also have to keep in mind when you're talking to consumers, they're not mortgage professionals. They don't understand the mortgage language. They want to be told in the most understandable way, the easiest possible way, that what is an ARM, right? A lot of time, if you even tell them, hey, are you interested in an ARM loan, they may not even know what you're talking about. So we just talk about it in very comfortable manner of, hey, there are mortgage programs out there that have a shorter lifespan, but it's good for, like we're discussing, 3 years, 5 years, 7 years. And then we just get into the pros and cons. If they're interested, if they want to really pursue the adjustable rate mortgage concept, that's when we actually go into the ARM table and try to explain to them that, all right, this is what your payment is going to be within the fixed period of it. And then this is what could happen basically as it adjusts, right? And that will be something that will basically utilize I think we just go back to our loan estimate. We basically pull out a loan estimate and utilize the table that is in a loan estimate talking about the payment difference on adjustable rate mortgages.
Yeah, good stuff, man. Hey, Houtan, if somebody wants to reach out or contact you or get to know a little bit more about what you do, is there any way they can they contact your publicist, or how does that work?
Sure. Well, being a camper, and that's California Association of Mortgage Professionals, I will always be part of the association. That association saves our industry, and I will be forever grateful for what the association does for the mortgage industry. So I would say, if you're trying to get a hold of me, just look up the California Association of Mortgage Professionals. And when you contact CAMP, you can find me. So that's my plug for CAMP. If you're not a CAMP member, make sure you become a California Association of Mortgage Professionals member. But Houtan Hormozian on Scotsman Guide, on Instagram, on Facebook, on LinkedIn. So if you just type my name, you'll find me somewhere.
Outstanding, brother. Great information. Thanks for bringing this. Frankly, it's an old technique that's kind of lost a little bit of flavor with the interest rates being so low. And now that they're back to what veterans like yourself and myself would call a more normalized rate, it certainly looks like a good option to at least know about. And now, for our listeners, now you know about. So again, thanks so much, Houtan, for coming on and sharing this. Again, go check it out on the Scotsman's Guide. If you go look at scotsmanguide.com, and you'll look in the July edition of the residential. The name of the article is a good loan option with an asterisk. And the asterisk is the information that we've been giving you here of the pros and cons of it. So great stuff, great article, and we look forward to the next one, my brother.
Carl, thank you so much for having me, and special thank you for Scotsman Guide for doing everything that they do for the mortgage professionals out there.
Class act organization, no question about it. So, hey, listeners, 2 things we're going to ask of you. Number one, forward this to 3 of your favorite loan officer friends. Let them know that this service is available. It's complete. It's a gift from the Scotsman Guide to the industry. So we appreciate you forward it to 3 of your favorite loan officer friends. And also, if you're watching this on one of the podcast platforms like iTunes or Stitcher, Google Play, wherever you happen to be, iHeart, wherever you happen to be watching this, if you'd give us a good, honest review, We really appreciate that because that helps drive the search engines and getting the message out for our industry. So thanks again. Appreciate you guys, and we'll see you on the next episode of the Author Showcase. Thanks again, everybody. Bye bye.